Welcome to today's webinar, compiled and produced by the team at BizNews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the BizNews.com channel on YouTube. Yep, it most definitely will. And a warm welcome from me, Alec Hogg, to the webinar today. You can see the good-looking guy there is Stuart Lohman, my colleague and our managing editor here at BizNews, who is in the Ferret Cape. Stu, that's looks like you got good sunshine at that side of the world. I hope the cold fronts that you send us aren't some more on the way.
I know Talib always says don't trust the forecast, Alec, but cold weather is coming. It's it's about to hit here. It's on its way. So I think it's on its way to Joburg next 2 days.
Oh, yeah, goodness me. Well, anyway, we've got many other things to worry about outside of cold weather. But Stu, as per always, you want to make sure that everybody is actually able to hear us and know how to pose their questions.
Excellent, thanks, Alec. Those new to the webinar, on your right-hand side, there's a control panel. On there, there's a little high-five button. If you can see Alec and myself and hear my voice, please just give us a high-five, just so we know that it is coming through loud and clear. There's also a nice presentation, front slide at the bottom there. Excellent, Alec got the high-fives. We do like to keep it conversation as well, so please put your questions into that same control panel. There's a little question mark there, and I'll pop them onto Alec as you run through, Alec, but I know there's lots of interesting insight to get through today, as the headline says.
And I see there's a question already from Lionel who says, please discuss Tongaat. Lionel, you're going to get full value today, I can promise you that. Okay, well, welcome everybody. It's lovely to have all our BizNews Premium members together in this webinar, and of course, Standard Bank online share trading customers as well. It's really a privilege for us to be bringing you this portfolio every month. Just to highlight a few things, there is no way that you can invest directly in the portfolio. We used to have that, and then started getting so big that I realized I was going to have to become a money manager. Sorry, I'm going to take these glasses off. I don't actually need them. The screen's not that far away. Anyway, so we took a decision at that point that let's rather just give you information, share with you what we understand and what we know, but not to be there to manage your money. So really the idea of this is very, very simple. It is that you follow the portfolio in the way that you want to and make up your own mind. We are doing this so that we can keep you updated on opportunities so that you can do your homework thereafter. That's the first thing. The second thing is that we are going to be closing off this portfolio at the end of this November, and starting a brand new portfolio in December. Reason for that is the portfolio is now nearly 7 years old. So don't worry about it if you're invested in this portfolio and you say, oh my goodness, I'm not going to get updates anymore. We'll continue to update it. We'll keep it there. But we're not going to be making any changes in the future because there are so many people in the BizNews community who weren't around with us or weren't members of our community back in 2014 when we launched this portfolio. But we'll still have it on the side. However, we will be making it a lot easier, making a new start, if you like, in December with a different portfolio, and that'll open up the way for new people to invest. I will warn you that my investments usually are pretty poor to start with. Amazon, it's hard to believe now that we bought Amazon $327 and it went below 300, and we bought Apple at the time before the four-way share split at 120 and it went to like 90. So don't panic. This is a long-term portfolio, and so will be the one in December. Anyway, that's by way of background. Let me take you through, it's quite a enticing headline. I think Stu and I can take ourselves off screen now. We'll come back just to show you that we aren't cardboard cutouts. We'll come back to the screen a little bit later. But as you can see there, triple sale happening today. I'll explain to you in a moment why. The compound annual growth rate of this portfolio over the 6 2/3 years that it's been in existence is 21.9% in US dollars. Funny, it's been that number for the last 3 months. I had to go into the into my calculation to make sure I hadn't done something wrong, because it's most unusual to have 21.9% as a consistent number over 3 months, but that's what it is. And so I did double check it. That has taken $200,000 that we invested initially to, as you'll see later, about $700,000. So the idea in investing is just give yourself time and don't try and make ridiculous returns. Just give yourself time, consistent returns, make the right investments, do your homework, and let the market look after you. In rands, the returns have actually risen over the last 3 months, and the compounded return there, 27.1%. That has taken about just over 2 million rand to 11 million rand. It's incredible when you put in the what Warren Buffett calls the 8th wonder of the world, the benefit of compound interest. So let's get into it. The looting in South Africa is unprecedented. I've lived quite a few years. I've seen some strange things happen. I was in school when the 1976 riots occurred, but living out in the rural areas, I suppose, a small town, it didn't really affect us that much. Certainly there were no thoughts of the kind of mass issues or mass looting and rioting that we saw happening in the past week all over the country. Sorry. Back in not all over the country, all over the province that I come from, which is KwaZulu-Natal, and also in parts of Gauteng, which are close to the single-sex Zulu hostels, which should have been disbanded during apartheid, let alone after apartheid. They're still there today. So people come up from the rural areas, the Zulu guys coming for work in Johannesburg, and they live in these massive single-sex hostels in various parts of Johannesburg. And there was also problems in largely Zulu-based areas. But I'm not going to get into all of that. All I'm going to say to you is that something has changed. Something dramatic has changed in South Africa. The fundamentals have altered, and particularly in the KwaZulu-Natal province. And one of our stocks that's in the portfolio that has done really awfully for us has been Tongaat Hewlett. One of the biggest investments or biggest appeals of Tongaat Hewlett is a lot of land that it owns in KwaZulu-Natal. Now, if KwaZulu-Natal is going to lose a lot of its businesses for very good reason, because during these riots, the security forces were absent. There's many ways you can look at this. The police live in the local community. Had the police intervened with water cannon and gas canisters, as they would have done presumably anywhere else in the country, then the rioting would have been stopped or nipped in the bud, but those individual policemen might not be around today. So there's all kinds of different equations that you can run into here. However, we know that during these 5 days, or well, in certain areas, 7 days of lack of any resistance from the security forces, businesses were trashed. There was widespread rioting, and the police literally stood by and watched it happening. That's in KwaZulu-Natal. So if you are talking about a business in KwaZulu-Natal today, or if you own assets in KwaZulu-Natal today, you have to believe at the minimum that the risk has risen considerably. A big part of Tongaat Hewlett's business is in the province, unfortunately. In fact, it wasn't long ago that it was the biggest industrial operation in the province. Aspen has now overtaken it in that regard. But this has put risk on for an already risky company, and it's too rich for my blood today. So we're dropping that as a direct result of the looting that has occurred. The second thing that's happened over the last little while. We'll get into in a moment, but let me just unpack this for you in a little bit. There's the rand versus the US dollar, and consistently over the past year, I've been suggesting to you that it is a good idea to be investing offshore more aggressively. And as you can see, the best time to have done that would have been in late May or mid-May, when the rand actually broke 13 Rand 50 against the US dollar. It's now just below 15 to the US dollar. And the uptick that we've seen, or the weakening that has occurred since the Zuma was arrested on the 8th, and then you can see on the 9th the looting began and the riots began with the problem is that you can have riots, but if there's no protection of business, then the consequence of that, the message that sends to business, is extremely scary. I would refer you to an interview that I did yesterday with Melanie Vaness, very impressive chief executive of the Maritzburg Chamber of Commerce. In that discussion, Melanie lays it out. And it's interesting how many of our most courageous commentators in South Africa are female. Very interesting. But anyway, she lays it out and she says, people should know what happened in Pietermaritzburg. We can't revise the laws. The police and the security services stood by idly. They were perhaps complicit, she says, in what was going on. You have to believe that at least, at the worst, the police had some kind of sympathy with those who were doing the looting, which is bizarre. The other thing was when the army did finally arrive in Pietermaritzburg on the Friday, they didn't protect the businesses. She says they went to go and protect only government installations. That's great. That's really crazy. And when you look at this, at the way that the rand has reacted since the looting and rioting, it's almost like the rest of the world, or certainly those people who are determining the value of the rand versus the US dollar, is underestimating the impact. Maybe I'm overestimating it, coming from KwaZulu-Natal, knowing lots of people, having done a lot of reporting on this. But it is a big province. It's the most populous province behind Gauteng. So it's a lot of people live there. More than 11.5 million people of our 58 million live in KwaZulu-Natal. If that part of the world is allowed to slide off the map, a little bit like the world allowed Zimbabwe to slide off the map, the impact on South Africa is vast. So it doesn't appear as though the full consequence of this has been appreciated yet, which I would guess is one of the reasons why South Africans are now investing offshore as aggressively as possible. But bring that all together, when it comes to KwaZulu-Natal, it's uninvestable, in my opinion, at the moment. Unless we see some kind of dramatic change that comes from the government, and so far we've seen none of that. The only reason that the rioting ended in KwaZulu-Natal was when riot police were brought in from other parts of the country. So Ramaphosa is right when he talks about it being an ethnic issue with the Zulu people. The Zulu people were not being stopped by Zulu policemen. It was only when policemen were brought in from the Western Cape, from Mpumalanga, even as far away as Uppington, that the rioting was quelled. So that tells you something. Are you going to leave? Are you going to police the province only with outsiders? Is that feasible? And if it isn't feasible, what's the guarantee that you're not going to have a repeat of this if you have the same policemen in force? We know, we all, not all know, but certainly we know the stories about police stations literally being boarded up and the occupants leaving, just departing. I'm not making this up. You can listen to the interview I had with Jason McCormick from McCormick Property. They have developed 68 shopping centers around the country, mostly in rural areas, a number in KwaZulu-Natal. He said there was a police station. He said very little support from the police, but he said one police station, which was a few hundred meters away from one of the shopping centers. That's literally what occurred. when the rioting began, when the looting began, those policemen all went home and said, no, they were on strike for wages. Extraordinary country we live in, but the fundamentals have changed. We need to change with it. The second thing that's happening where the fundamentals have changed is in China. Now, I could kick myself on this. On these webinars over the last many months, we've been waving flags about what's going on in China and how China is progressively, Beijing is progressively starting to pull the business people into line. It all began last year around November when Jack Ma, the founder of Alibaba, made the statement that he made statements about Beijing that the Communist Party did not like. And Jack Ma has been taken out, certainly financially, in the most brutal manner. We haven't heard from him for quite some time, but his a spin-off from Alibaba called Alipay was about to be listed on the New York Stock Exchange, the biggest listing ever. And 2 days before the listing, it was pulled by the Chinese authorities on some spurious ground. The embarrassment that caused has been enormous. The escalation of that war against capitalists in China has been very, very obvious to see. We saw the Chinese equivalent of Uber listing in New York, even worse than Alipay, this one, because a lot of investment went into the company. And the day after the listing, the central government in China started attacking the company and saying it needed certain information, certain data. The company was breaking the law and really muscling and strong arming it, forcing it to withdraw its app from the App Store. Now, if you're an Uber, if you like Uber, how can you operate if you don't have an app that is available to people to download, through which they will call your the ride-hailing app? And it's continued. In the last week, we've seen the focus switching towards Tencent, which has come under enormous pressure as well in the last couple of days. One of the issues that is very relevant in this is that the Chinese central bank has instructed both Tencent and Alibaba, who make a big chunk of their income through their payment systems. It's instructed the two of them to assist the central bank in developing a digital payment system which will replace their biggest profit generators. It's crazy stuff that's going on in China, and I don't want to be part of it. I don't think you should be either. This graph that was pulled from our partners at the Wall Street Journal this morning shows exactly what's going on. Whereas on the NASDAQ, you can see in the last 12 months, it's been pretty steady, as one would expect from an exponential or from an index that tracks exponential companies. On the other hand, in Hong Kong, it's gone the other way and continues to go the other way. There was a wipeout yesterday. Tencent lost 7.7%. When I looked this morning, it was down another 5%. Tencent is the reason why Naspers is the share price that it's at. Excluding Tencent, Naspers would be a fraction of its current share price. But as a consequence of that, the two are joined at the hip. That's not just Naspers, but also Prosus. And what should be worrying investors in Naspers and Prosus is the fact that this company has paid something around $10 billion in buying back its own shares at a price which is substantially higher than the current price. Now, there are two issues there. First of all, they've wasted a lot of shareholders' money. But secondly, if that $10 billion was not used to buy Naspers and Prosus shares, imagine where the share price would be today. So if you didn't have that huge share buyback program. So what does it mean? Well, before we go into the triple sale, in the past month, there is a breakdown of our portfolio. And if you look at the bottom, because of the weakening of the rand and an appreciation in US dollars of the portfolio, we've actually gone up. The portfolio has gone up to just over 11 million rands. Remember, it started around 2.5 million in 2014. And then you can see in US dollars, it went up slightly. It's just under 750,000 US dollars. We started with 200,000 US dollars in December 2014. So that gives you an idea of, as I said earlier, the power of compound interest or compounding, just at 21%. But have a look at that. Naspers today is down at 2,500 rands. It's down 16% in the last month. Of course, you can kick yourself. You should have sold it a month ago. Then also under pressure this month has been Spotify. That one I don't worry about at all. Wilson Bailey has done okay, and Tongaat was so low, it's you can't, even after the riots. And I don't know if that's been worked into everybody's calculations. Obviously, there's some bargain hunters who think at $7 the shares are cheap. They went down to, I think, as low as 6 rand in the wake of the riots. Netflix, after its results, has been normal, and Discovery has not been impacted yet by China. I don't know if there's been a connection made by investors that a big part of what you're getting in Discovery is it's 25% of Ping An Health. That's a big part of the appeal for us. And on the other side, when you look at the other parts of Discovery, although it's doing well in the UK, or reasonably well in the UK, here in South Africa, they are taking on some very strong competitors with Discovery Bank. It's not yet clicking into gear in the way that it was anticipated, and the reluctance of people to move bank accounts, something that Discovery itself has flagged, is an issue. Also for Discovery is the fact that the third wave, which came along, although the mortalities haven't been as bad, the hospitalizations certainly have. And Discovery has not, it seemed at one point that Discovery was going to ride through COVID, and it made enough precautions for it. However, with the third wave coming along and this continuous COVID issue, it appears as though mankind has now got into the basis where, with the coronavirus, everybody has to be saved, and it doesn't really matter what it costs. That is an issue that doesn't sit well with running a business. So the big thing for me about Discovery right now is that its investment in China in Ping An Health, which was a jewel in the crown, given what Beijing is doing, is not so much anymore. And that certainly changed my mind towards it. There are other issues as well, but they wouldn't be significant enough to make that fundamental change, which you'll see we've done in the portfolio. On the other hand, nice improvement there by 2U, which has been one of those stocks that has underperformed relative to the other exponential companies that we own in the portfolio, and continued the big three: Apple, Microsoft, Amazon. They just keep powering ahead. Purple Capital, very happy with that performance. It did shoot up a little, perhaps too aggressively after the transaction that was done, where a new shareholder group was brought into the company. And Zero, a bit offset, good share price improvement for Zero, but a bit offset by a strengthening of the Aussie dollar against the US dollar. So the price of Zero is in Aussie dollars. So as you can see, that's the past month's movement. The fundamentals have changed. I hope I've articulated that properly for you. On Naspers, Discovery, and Tongaat, certainly in my mind, we are selling them. We only go into this portfolio once a month. So we only make changes once a month. From your perspective, you probably get a little bit more for Tongaat, maybe a bit more for Discovery. I'm not sure about Naspers. We had to sell this morning. I could have sold last night, and I'd never have done that and boost the figures, but we sold first thing this morning, or the prices of the first thing this morning. And to me, it's the alarm bells have been ringing for a long time, and now they finally have rung loud enough for me to get through my maybe wax blocked ears. But that's what's happened. We have sold today those three stocks, and we are keeping the money in cash, and it's boosting the cash from 0 to 16% of the portfolio. there's a better indication of what's happened. Tonguat has been a disastrous investment. It was done on the basis of excitement about Zimbabwe. I remain excited and optimistic about Zimbabwe, but that is way offset by the impact of the riots in KwaZulu-Natal. This being the province's biggest company, and with a big chunk of its portfolio being in the land that it owns in KwaZulu-Natal, I cannot take a view for you, and certainly haven't worked it in on how the negotiations with the banks are going to go. They're still in a tricky stage. Tonguat have got very good managers. They know you've really got a horse there that's being ridden by the best possible jockey. But is that horse up to it? And is that horse going to be able to be properly fed, given the consequences of what happened in the past 3 weeks here in South Africa, and particularly in the province where Tonguat has most of its sugarcane fields and also its land holdings? I don't know. Some of the sugarcane mills have also been attacked during the violence. Again, are they going to be reimbursed for that? I really don't know when I have a look at Sastria's situation. And that's probably one of the biggest worries for businesses in KwaZulu-Natal. Sastria, according to the information we have, and we in the process of confirming it, transferred, I think it was 50 billion rand from its reserves, which had been built up over decades. The riot insurance was introduced in the 1970s. It transferred that across to Treasury in South Africa, and now it's sitting with only 6 billion rand in reserves in the Sastria. That's the risk insurance, national risk insurance, riot risk insurance underwriter. And with that 6 billion rand, the claims at a minimum are going to be 30 billion. 20 billion of that from KwaZulu-Natal as by conservative estimate, and considerably more on top of that from what happened in Gauteng. So those businesses, and we would presume that Tonguat would be amongst them, that is trying to reclaim for the damage that's been done to its assets, might have to settle for a small part in the rand. The Sastria people are ducking and diving. We can't get hold of them. We're still talking to actuaries who are a little reluctant to go on the record, but I'm sure we'll get someone to comment on exactly what the Sastria situation is. But if you are exposed to that, rather, the fundamentals have changed. Tonguat is not what it was pre the riots, and we're out. As far as Naspers is concerned, I mentioned earlier, we should have taken a profit a long time ago when it first started. The reason we didn't do that was I was always reluctant that Naspers executives would see the light and unbundle Tencent. Had they done that at any time in the last 18 months or so that we've owned the shares, the share price would have gone up by 30% at least, because it trades at a 50% discount, the Naspers share price, to the underlying value of Tencent, let alone anything else, or it certainly did. The way Tencent's falling now, that's going to change too. But anyway, we're out of that. It's not every day that you get a seismic shift in the government of a country where your asset is effectively invested. And I only fear here for South African investors, because Naspers and Prosus still make about 1/5 of total equity portfolios in South Africa. And if the fallout continues, and there's no reason to think it's going to reverse anytime soon, that wonderful gift that Naspers has given, or Tencent has given, to South African retirees and investors is not going to be there any longer. On Discovery, we made a healthy profit there, buying in right at the bottom of the, very close to the bottom of the disaster. So that looks a lot better. And at the moment, the upside for Discovery, given what's going on in China, has definitely been dampened. So those are the sales. The portfolio pre-sale, this is what it looked like coming into this morning. as you can see there, big weighting, Amazon, Apple, Microsoft. So 55% in those three. Naspers was 7% of the portfolio alongside Discovery, so Netflix, and Discovery was 6%. So 7 and 6 is 13. Tonguard another 3. That's 16% that we've sold out of the portfolio. And the portfolio now, post-sales, sitting on 16% in cash, and the numbers there of the portfolio, as you can see, are broken down roughly 4%. Then in 4 of them, very happy with those shareholdings as well. Individual stock performances of the portfolio. The Rand weakened during this period from 14 in the last month, from 14.30 to 14.89, as you can see there. That's the way the stocks have performed over the past, well, ever since they were purchased. And that gives you an indication of Amazon, how it's pulled up the value of the portfolio. And that, dear friends, is the story for now. I just wanted to dwell on this a little bit in the past month's movement. As you can see there, those who are going out of the portfolio, Tongaat, Discovery, it wasn't that bad. And my question would be yet. Whereas Naspers, if we'd sold earlier, of course, we would have looked a lot smarter. But anyway, that's the story, and that's where we are today. Stu, do we have any questions?
Thanks, Alec, as always. Just on Naspers, Dave wants to know, have you obviously sold the entire holding, which I assume yes. And he says, what about Prosus? Would you have sold that holding too if you held it?
Yes, yes. They are the same company, essentially. They are, both Prosus and Naspers are dependent and reliant on Tencent. They trade at a discount, depending on what point in time you look at, but up to between 30 and 50% on just what they own in Tencent. So if you imagine you've got shares in Tencent and you've got other assets as well, just the shares in Tencent, they trade at a 30% discount minimum to just, and that's Prosus has got a smaller discount than Naspers has got, just to the Tencent holdings. Now, that looks like it's real cheap, excepting if Tencent's share price it falls dramatically, then that discount becomes obviously less and less, and the impact on Prosus and Naspers would be the same. Yes, I would have sold Prosus too.
Thanks, Alex. So then Aresta says, so it would be silly to wait for the Naspers to Prosus transaction.
Well, this is just a guide. If you do the transaction, you are still betting on Tencent reversing the recent decline, and that means you're betting on the Chinese government changing its approach that it has now pretty strongly implemented in bringing the capitalists of that country under its jackboot.
Thanks, Alec. Mark just wants to know, do you think it's time to take some profit on 2U?
No, Mark, no. We don't take profit. In this portfolio, literally, we don't take profit. The investment holding period in this portfolio is forever, and that's based on Warren Buffett's view. However, if you have a fundamental change in the underlying company, then you sell. Buffett tells us there's never one cockroach in the kitchen. It's got lots of cousins who come along. And the consequence of that, if there were a cockroach in 2U, then we would address that too. And we've done a lot of that over the years. The most famously, the biggest fortune that we had was selling Metro Bank in the UK when it was £30 a share, or slightly north of £30 a share, on the basis that its founder was starting to hit the headlines for all the wrong reasons. He'd given his wife jobs to develop some of the designs of the branches, and it just didn't smell good. And as a consequence of that, that was that first cockroach, and we left, and you can buy Metro Bank today at under £1 a share. We sold at £30. So it's very good advice from Buffett. If something fundamental shifts, or if there is a scandal, that's the only reason why you sell. You don't sell to take profits.
Thanks, Alec. Leonard just wants to know, obviously with the China change, should he drop Alibaba.com? It's also in the headlines.
I can't say to you, this is what you should do. All I can say to you is this is what we do, we would do, and we are doing. And I can tell you that the only shares that BizNews own, or BizNews staff own, are in this portfolio. Otherwise, and we can't buy and sell before you know all the numbers. So, for instance, in my own portfolio, I will today enact the sales of the shares affected, and hopefully in time to come, the others that are held in the portfolio will also appreciate alongside yours. So, it's very difficult. In financial journalism, you've got to be very cautious about being seen to favor particular companies, or to have a personal interest in particular companies. If any of our colleagues or myself own shares in a particular company, and we write about it or broadcast about it or say anything about it, we would disclose that to you. So as far as Alibaba is concerned, we don't own it in this portfolio, but the concept there is that the Chinese government is giving Chinese companies that are listed on international exchanges a really rough time. And it's in their minds, they might say, well, autocratic states always do this, is that they would justify the decision on some other basis. But actually, when you look at it with a rational mind, the decisions that have been made here is to show that capitalism does not control communism in China. In China, the communists rule. And they are showing us that in a very big way. And if the capitalists get too uppity, as in Beijing's view they have become in recent times, then they will be brought under the heel. And Jack Ma is still involved in Alibaba, although he's retired from it. I presume certainly Alipay is he's the chairman there. That's a big part of Alibaba. It wouldn't look happy. It wouldn't look like certainly the future is not as good as the past for those companies, for Chinese companies. That is now pretty obvious. And the other thing, of course, is that, like with Tencent, if the central government makes a decision, some of the decisions are quite well documented. The decision that it made with its biggest private education company took 70% off the share price last week. So those are, and you can't go to court. Like in this country, in South Africa or the US, obviously in the Western world, you could go to the court and challenge the government's decision. You can't do that in China. If the government decides on whatever basis it wants that it is going to enact and implement what it might call antitrust regulations, which is what it's been dressing these things up as, then there is no court of appeal.
Great, says, thanks for the update, Alec. Don't you see Discovery as a disruptor, and that the current challenges are just noise, i.e. the fundamentals are still in place for the company?
Yeah, it's a great company. It's got good people. It is a disruptor. It also has a big chunk of Ping An, 25% of Ping An Health. And that, to me, is a big reason why I was keen on the shares and bought the shares into the portfolio. Ping An Health now it's Chinese. And that has to be influenced in the very least by what's going on from Beijing, especially as it's in the health sector. Yes, Discovery is a good company. Is Discovery worth the 120 Rand a share? Probably. It could be worth much more than that. But for me, the exponentiality in Discovery was through the investment that it had in China. And that, to me, is no longer, it no longer qualifies on that basis.
Terry just says on Naspers, Alec, if you hadn't sold it and the things hadn't changed in China, would you have taken up the process offer?
Yes, definitely. I said that in the last webinar. Because you're reducing the discount. And if you're going to hold on to Naspers and hope that things change in China, and they may, this could be a lot of noise. The issue here is that the risks have increased, and when you invest in companies, it's like living in somebody who buys property in KwaZulu-Natal today. They are taking a very high risk. The property is very cheap relative to historic reasons or historic levels. However, the risk is that it's going to stay cheap. And it's a similar thing with what's going on in China. At the moment, however, Tencent is not cheap. And it's not sitting on a PE of 8 or 10. It's on a price to earnings much, much higher, at a multiple of that. And if you, however, believe that you want to remain invested there, then if you own Naspers, my analysis of it was converted that into Prosus, because the discount of Prosus, because it's listed in Amsterdam, to Tencent is smaller than the discount of Naspers to Tencent. And also Naspers owns a few poorly performing assets, like its South African media assets, for instance, which are not in Prosus. So it would be a more appealing way into Tencent, and you get the rest of the Prosus international assets for free.
Chris just wants to know if you have any thoughts on any oil companies for future investment, Alec.
Chris, this portfolio is based very much along the lines of investing in exponential businesses, and exponential businesses are a play on or leveraging human ingenuity. So it's oil, like Sasol. We bought Sasol at 28 Rand in March 2020 because it was just ridiculously cheap. It was absurdly cheap. And if there were a similar opportunity available, then we would do the same. However, and then we sold Sasol at 145 Rand, and it's gone up significantly since the 145 Rand, but it was always an exponential play just because it had been ridiculously cheap. With the companies that are in this portfolio, all of them, from Purple Capital to 2U to Spotify to obviously the big three, Amazon, Apple, and Microsoft, are growing at an exponential rate of over 20% a year. And that is what we're investing in, is the ingenuity, the human ingenuity that is leveraged through those businesses. It was a similar thing with Naspers, which owned Tencent, which was growing at a similar level, and its profitability was going along with it as well. Similarly with Discovery, very much so with Zero. And that is, Tonguat was a different story. The exponentiality there came from Zimbabwe, which was written off virtually. It completely written off. In fact, it was a negative in the balance sheet. So those are the reasons why we looked for exponential returns. That is oil and commodities, as well as commodities have done and may continue to do, please God, for South Africa's sake. They are not in our portfolio because it was an inanimate object that generates that price, not human ingenuity.
Robert just wants to know if you have any thoughts on Nampak, Alec, just on its value. I'm not sure if you've seen it or looked at it.
You know, if you listen to our BizNews Power Hour last night, was so interesting. There's our partners in London, the Financial Times of London. There's a little slot that we always run in the Power Hour from our partners in London. And last night they were talking about a share competition, a share game that they've been running for the last year. And Mark Filipino, who's the host of the podcast that we run, said that he had invested, he'd even forgotten about it, but the person who's organizing it said, yeah, you've done very well out of international paper. And he said, yeah, I invested in that. I don't even remember the name of the company actually, but I invested in it because with home deliveries, I could see that there'd be more packaging, and then packaging companies and paper companies and cardboard companies would do better. So that was his reasoning. And I made a mental note of that, to go and have a look at Nampak and to see how it has performed, because I remember interviewing the CEO in our studio before COVID actually came along, and I was very impressed with the way that he was sorting out a lot of the issues from the past. Andre de Ruyter inherited a big mess. He did quite a lot of good work there, but now it seems as though much of that mess is being cleared, particularly the investments they made in other parts of the continent. And they should have benefited from the pandemic because of the surge in home deliveries and so on. So I had a mental note. So I think you're onto something there. I would certainly suggest you look at it. We got 16% in cash now, so we'll be looking at some South African companies. The other two I'm looking at, but a bit cautious about because of the valuations, are Transaction Capital and Capitec. And Capitec is one that you just think, well, why heavens, what does it going to take to get through to my thick head that this is a fantastic business? And Transaction Capital, I didn't know that well, but it's heavily exposed to high growth areas, including taxis, financing of taxis. And suddenly, through the rioting, if there was one good thing to come out of it, it's the strength of the taxi associations and the taxi industry. And if it's going to play an increasingly bigger part in South Africa's economy going forward, and a part for good, one hopes. So that's Transaction Capital's there. Of course, they just bought WeBuyCars at a very, very good price. And WeBuyCars, being the dominant player in the second-hand car market, is also a big opportunity for Transaction Capital. So those are two that I'm looking at, but I will add Nampak to the list and see. Perhaps it hasn't been factored into the price yet, that this change in our lives post-COVID is going to benefit companies like Nampak.
Mike says you bought Spotify at 234. It went up, it has dipped. Would you consider buying it at the current price? Would you use the cash you have freed up to buy more?
Yeah, I remember we bought it at 234 when the rand was in the 13s. Now the rand's almost in the 15s. So that is a problem. And we got a good holding there. I'm quite happy with the percentage holding that we have in Spotify. It is a high growth company, but 4% is a good holding. If you don't own any, then certainly do. We'll put it this way: if we didn't own any, I would be buying them.
Thanks, Alec. You mentioned the cash holding of 16%. I've got a few questions on what you plan to do with that. I'm calling it the elephant in the room. I don't know if you have had any thoughts on where you want to put the capital.
Yeah, it is. I'm looking at it now, very much in South Africa, for companies that can benefit in South Africa, and the two highly rated businesses that seem to be completely bulletproof from any social unrest or any other issues. And remember, the social unrest was really restricted to Zulu areas, particularly KwaZulu-Natal, but also in Zulu areas in Gauteng. So there's a whole rest of the country that's unaffected, and most of the indicators were suggesting we were going to bounce back very strongly after COVID as the vaccines go through and as we start reintegrating. Perhaps because we've come down so far, but there's a big rebound opportunity. So I am looking at those those two companies that I mentioned. I'll put Nampak onto the list as well. And of course, the world is big. There are many, many opportunities. But before we buy into anything, I really believe you need to do your homework, because your holding period for the stock is forever. So you need to be pretty sure that you've got into the right area. At the moment, I just am a little bit. I didn't want to make a quick jump into Transaction Capital and Capitec because the shares do look pretty expensive, which they deserve to be. So, but let's see.
Excellent, Alec. Haroon, wants to know, would you look at selling WBHO in light of the recent looting, and also where Sasria finances have fallen short and has created an additional drain on the fiscus? So overall, the looting has left government poorer for infrastructure growth going forward.
Yeah, those are excellent questions. And I did scratch my head about WBHO. I don't think that WBHO, the rationale for having it in the portfolio has changed at all. It is the blue chip in construction in South Africa. We did buy it on the basis that it had a fantastic asset in Australia, which well, in fact, had the Australians not fallen out with the Chinese, would have more than covered the current share price. That didn't happen, but it wasn't bought on that base. It was just bought that it was cheap on the strength of the asset that it had in Australia, and on Ramaphosa telling us that infrastructure, there was going to be investment in infrastructure, and actually that's the only way you're going to get South Africa out of this mess. I mean, not the only way, I suppose, money could come from heaven, but generally speaking, if you are going to grow an economy, you need to invest in infrastructure. There's been an enormous amount of damage. Somebody's got to fix it. Wilson Bailey would be front in line if you can afford them, putting it that way. So that's kind of a starting point. The government's infrastructure program, there's less money around now, for sure. But unless this government really grasps the nettle, and it doesn't seem to want to, as we saw with the recent negotiations with the trade unions. We saw in the budget that the budget books kind of balanced. No, they didn't really balance, but they looked kind of okay because of 265 billion rand that was going to be cut off the public sector wage bill. Well, we know what that's worth, given that the public sector employees have just got a salary increase. So it's really, when you start guaranteeing the improvement of a company's business on an ANC government doing the right things, then you're on a bit of a fool's errand. But with infrastructure generally, this country has got to improve the infrastructure to start creating jobs, to start kickstarting the economy. And perhaps the IMF, when they take over running of the sovereign affairs of this business's of this country's finances, which is now, we're getting close to that. We can't be too far off from the ANC government going to someone and saying, please help us. And were it to be the IMF, they would probably have some pretty strong words about what to do with infrastructure. So those are all suppositions. I'm happy with Wilson Bailey. It's a blue chip. It's got a great asset in Australia, and it's well positioned here in South Africa for whatever happens. Because if you are the last man standing in any industry, you will have a disproportionate benefit.
Just on the infrastructure there, Alec, EJ wants to know if you've ever looked at AfriMat, and then Christo throws EOH into the discussion as well.
Yeah, AfriMat is definitely, it's a fantastic business. In fact, when we bought Wilson Bailey, it was a three-way selection between AfriMat, Italtile, and Wilson Bailey. So yes, and of course, had we bought AfriMat, we'd be talking about it in glowing terms today. You can't always get it right. However, had Wilson Bailey sold the Australian asset, or the Australian government had allowed the Chinese to buy that company, then we'd be very happy with Wilson Bailey today. So that's what happens in the world. One doesn't know the future. AfriMat, fantastic business, extremely well managed. if you've got it in your portfolio, it's one of the few commodity businesses where you truly are buying into the ingenuity of the human potential. So it's got kind of both sides. So if you're a shareholder there, you're in the right place.
Excellent, Alec. EOH, I know we've spoken to Stephen a few times. Krista just wants to know your thoughts on EOH.
I can't, Krista. As much as I think they've done a fantastic job, and as much as I think that it's cheap, they've just sold off so much of the business now. And as an exponential opportunity, where is the exponentiality going to come from? On the one hand, you still have fights with the government. The government is if you in a big organization, and I'm sure many people listening today will be able to relate to this. Sometimes when you are faced with a decision, the best decision that is being made is no decision, which is actually a decision, but to not do anything. It's not a good decision, but nothing, or to take the safe route. Now, if you've got bosses or people in the organization who at some point in time look at want to hold something against you, and you go and give EOH business, it's very easy for them to hold that against you. And really what I'm saying is that EOH is a high risk business partner at the moment through none of the doing of the current management, but through the corruption of the previous management. They don't have the Microsoft licenses back yet. Once Microsoft gives them those licenses back or gives them the rubber stamp, that's the time to look at EOH in a different light. But the problem is to clean up the business and get rid of all the debt, they've had to sell some fantastic assets. And what's left there now, can it grow exponentially in an economy that's not growing? It's question marks. So yes, it is cheap. And if you're in it for the long haul, and you know people and you know the business and you know the tech side, I would be the last person in the world to say sell it. But it doesn't qualify on all the exponential opportunities. You know, if you look at, you're comparing whatever you invest in, you compare with other companies now anywhere in the world, and that's what WebTrade is all about. Xero in Australia. If I were to rank that next to EOH, it would be a no contest. Xero has got the best accounting system, online accounting system on earth. It's starting to expand into the biggest markets in the world. In America, it's doing well in the UK, starting to move into Europe, doing very well here in South Africa, and of course it's tied up Australia and New Zealand. Would I go with EOH, which has got a lot of things hanging over its head, or Xero? Xero's for me.
Sure, Alec, this always goes very quickly, but I think you touched on a point that Paul asks, and he talks about surely there are better investments offshore than what you're looking at in SA, and I think that goes back to SA makes up 0.7% of the investable universe.
You spot on, Paul, and that's exactly what the story is here. We always do like to look in our own backyard and try and find great businesses here that we can invest in. But you're right. There are some offshore that I have been toying with. If I'd listened to David Shapiro with ASML in Holland some time ago, he's been riding that horse for a long time. Well, again, that was one we missed. If we hadn't sold Tesla, keeps your feet on the ground. That decision also. The point about investing, I think, is that you do your homework. You find the right assets, some companies that you understand and that you can kind of believe their story of where they're going to, and you invest in them and watch them like a hawk. And if there is a cockroach, or if there's a fundamental change in that business, in the underlying business, as I now believe there is in anyone who's doing business in China, then you must reassess. And if you're sufficiently worried by the change, in other words, if that change had been there when you made the initial investment or initial decision to buy into that company forever, and if that it would have changed, would it have changed your decision? For Naspers, it definitely would have for me. And that's why Naspers has got to go out the portfolio, as with Discovery. And you'll know that I've been a big fan of Discovery and their management for a long time. But the thing that tipped them over, apart from the ridiculously cheap price that occurred in March 2020, was the investment in Ping An Health. And now that's changed. So yes, you're absolutely right. We won't rush into anything. If we do make it, and that's why we haven't added Capitec and Transaction Capital to the portfolio, because yeah, they're great by the JSE standards, but we should be comparing them with companies all over the world. And by that basis, there are still some incredibly good companies that we still got to discover and do our homework on.
Sure, Alec, thanks as always. I was up again, like I said, so quickly as always, but thanks for your insights again on everything.
No, it's my pleasure. And thanks for everybody who came. I mean, we had a really good turnout today, considering it's only BizNews Premium and Standard Bank clients. So I hope you are going to be taking the information that we give you every month, the updates that we give you here in the portfolio every month. It really is an opportunity to ask the difficult questions about, and sometimes I think it's just the questions that you may be asking yourself about the investments that you hold. I look forward to being back in your company again on the last Tuesday of every month. Eh?
Yes, Alec, except for December, obviously, but the other 11 months for sure, last Tuesday of the month. Yeah,
December we do it at, I think, before everybody goes on holiday. But sure. So we'll be back, diarize it, last Tuesday of August, and we'll be just about ready for the BizNews Investment Conference then, which should be a lot of fun as well. If you haven't booked, we are over the 100, which is the current. In fact, I think the current cap is 50. But if you look at the third wave, the way it's petering out in South Africa, I'm sure we'll get that. Well, I'm sure that will be increased substantially. And we we're over 100 bookings already. But it's going to be a fantastic conference. And what's nice is being in the Berg, away from everybody, and together in a group of BizNews community members and our presenters, etc., for a period of 3 or 4 days. Really, the one in March was special, and I've got a feeling that end August, beginning September is going to be even better. But it'll be just before the conference. In fact, look forward to being in your company then. From me, Alec Hogg. Cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.